This is the Japan market brief. Here is your Tokyo market close summary for April 16. Japan's market closed at another record high on April 16, with the Nikkei 225 pushing above 59,500 as investors continued to price in a more constructive path for U.S Iran talks. That helped stop the oil story from worsening further and gave Tokyo another session of risk-on momentum. But the bigger point is that this rally still looks relief-driven. It remains more about external fear fading than about a fully convincing improvement in Japan's domestic economy. The first driver was continued geopolitical relief. Japan has been trading around oil, logistics risk, and energy-sensitive inflation pressure. So when the market believes diplomacy still has a chance to hold, Japanese equities react quickly. The second driver was momentum. Once the Nikkei reclaimed another key level, the market had room to continue climbing. That matters because Tokyo has recently been trading in big emotional swings. When fear eases, positioning can move just as quickly in the other direction. The third driver was relative currency calm. Dollar-yen remained close to 159, which is still high enough to matter, but it did not turn into a new shock point. That helped investors keep their focus on equities rather than on emergency-style FX stress. Even so, this was not a perfect macro backdrop. Policy support around oil stockpiles is still in place, and procurement bottlenecks are still showing up in real economy reporting. That means Japan is still managing the consequences of recent energy stress, even while market sentiment improves. There is also the issue of selective domestic demand. Some areas tied to travel and inbound activity are doing better than purely local consumption. So when the market rallies, investors are still choosing carefully which companies deserve to participate. That is why today's advance should still be read as a relief-led market move. It was real, and the tone was positive, but it was not yet proof that Japan has fully moved beyond the recent oil and geopolitical cycle. Today's stock to watch is Suntory Holdings. NHK reported that Suntory will acquire Daiichi Sankyo Healthcare, and Suntory's official April 15 release said the transaction value is 246.5 billion yen. That matters because it gives the market a concrete company-specific story on a day when the broader index was mostly responding to macro relief. Daiichi Sankyo Healthcare owns well-known OTC brands including Lulu and Loxonin. For Suntory, the deal expands its reach beyond drinks and deeper into self-care, health products, and defensive consumer categories. That is strategically important. Japanese consumer companies are still navigating a mixed demand environment, so management teams that can diversify earnings and build more resilient profit streams stand out. Suntory is effectively telling the market that it does not want to depend only on legacy beverage demand. This also matters from a capital allocation perspective. In Japan, investors are paying more attention to whether companies use balance sheets to reshape growth rather than simply defend the status quo. On that measure, Suntory offered one of the clearest company-level signals of the day. Going into the next session, there are three things to watch. First, whether oil stays contained enough to preserve the relief trade. Second, whether dollar-yen remains stable instead of becoming the market's next source of stress. Third, whether investors continue rewarding corporate action stories like Suntory over pure macro-sensitive names. If those conditions hold, Tokyo can keep moving higher. If they break, the market may find that it rose faster than the domestic backdrop justified. That was your Japan market brief for April 16.